Welcome to The Explainer. Okay, today we're tackling a question that feels, well, a little contradictory. Stocks are hitting these incredible record highs, but at the same time, the economy feels kind of shaky, right? So, is a crash on the way? We're going to dive into some analysis that actually argues this whole rally is built on something way more solid than you might think.
I mean, this is the big one, isn't it? You see the headlines, stocks are soaring, everything's green. But then you hear people talking. There's all this chatter about slowing growth, trade friction. It just doesn't quite add up. So you gotta ask, are we in a classic bubble that's just waiting to pop? Or is there something else going on here? Something under the surface?
All right, so to really get to the bottom of this, here's our game plan. First, we'll lay out the big debate. Is it a bubble or is it real resilience? Then we gotta look at the case for being cautious. After that, we'll dig into the three big reasons why the market might be so strong. And finally, we'll see where the opportunities might be hiding in all of this.
Okay, let's jump right in with part one, bubble or genuine resilience. This is all about trying to untangle that investor optimism from what's actually happening in the economy.
You've probably heard this phrase before, irrational exuberance. It's basically Wall Street speak for when excitement and optimism just get way ahead of the actual, reality. And that perfectly captures what a lot of skeptics are worried about right now, the fear that this whole market is just running on fumes, on hype, instead of solid facts. But the analysis we're digging into today tells a very different story. So it really boils down to two competing ideas. On one side, you have the skeptic saying, look, it's a bubble, plain and simple, and it's all driven by optimism. But on the other side, you've got this analysis from JP Morgan, and they're arguing, nope, not a bubble. They're calling it resilience. And they say this strength is coming from something real. Surprisingly strong corporate earnings, and the fact that big companies are just really, really good at adapting.
Okay, so before we totally buy into that resilience argument, we have to do our due diligence, right? We have to understand the other side. So let's look at the case for being cautious, because honestly, there are some very real, very legitimate reasons to be worried about the market right now. First up, and this is a big one, tariffs. The average effective tariff rate here in the US has climbed to 20%. Now, just to give you some context for that number, we haven't seen rates like that since the 1930s. And historically, that kind of friction in global trade, it's a massive headwind for economic growth. And you can see the direct impact right here. It's not just theoretical. Economists are paying close attention. They've had to slash their growth forecasts for the year, taking them from a pretty healthy 2.3% all the way down to just 1.5%. That is a huge downgrade, and it's almost all because of this new trade environment.
And it's not just the economists who are getting nervous. The folks who actually model how much money companies are going to make, the equity analysts, they're lowering